The markets are coming off a jarring reaction to the recent macro data. Volatility surged, sending shockwaves across some of these key sectors in the S&P 500. In today's breakdown, we are going to explore how the ISM Services PMI and JOLTS data acted as a catalyst for these volatile moves and what it means for the road ahead. We're also going to be dissecting the current market conditions, key gamma levels, and the direction of that 5-day moving average to uncover any opportunities and risks going on right now in the marketplace. And before we hop into today's show, a big shout out once again to the Patreon community. If you sign up with the Swing Trader $9 tier or sign up for the annually, where it's only $7 a month for an entire year, it ends up being like $90 US. You get all types of benefits here. Just go click the link. I'm not going to talk much about it. And then also my partners, Interactive Brokers. If you do check out that link, make sure to check out the Interactive Broker Campus because they offer a host of tools. This is an award-winning brokerage and platform. They offer all types of services. Check them out if you haven't done so already. Let's get into today's stock market brief. All right, ladies and gentlemen, welcome back to the show. Well, we got ourselves a little bit of volatility back in these markets, and it was really led by, well, the larger market cap names, right? Tech was there to save us yesterday, but they didn't show up today. I thought it was supposed to happen every single day. NVIDIA was down a whopping 6.22%. Tesla was down 4%, and that move in NVIDIA is coming off the back of CES event that's going on. And wow, talk about a boom. Nice big gap up to start the day, and it closed at the lows on some gigantic volume. These type of candles can mark reversals in the market. Now, I want to, in the asset that we're looking at here, but I want to clarify that this also happened to be a new all-time high here. I believe a new all-time high for the price of NVIDIA as well, if not a new high for the year, and then close at the low. So sometimes this takes a little bit of time to recover, but it's not necessarily a bearish thing in this current moment. Now, if we take a look at NVIDIA on the 15-minute chart, you can see that big gap up over here, and then we close at the lows of the trading session. I'd be keeping a focus in and around this 136, 137 area. We do have a little gap fill down here and around 138 and some change, and we have the point of control right over here as far as volume goes. So right in this area, we kind of got a lot of confluence between this gap. We have this little trend line that acted as resistance, and then we move through it. So hey, you never know, it could present itself shorter term opportunities if you like to trade intraday. Tesla is also within this flag pattern and in bullish context. The 20-day is still rising in this current moment. The 50-day is rising. The 200-day is still rising. And on today's price action to the downside, volume was actually lower on this day. And you can see volume has been actually drying up here. So this could just be a consolidation or a potential flag. But to confirm this, you would definitely want to see this high taken out. If we go to the 15-minute chart on Tesla, you can see that line here as well. You can see it's been holding as this area of resistance. If we do get some move back to the upside, I would pay very close attention into and around 430 to 435 to potentially act once again as a level of resistance. That is the point of control these last 15 days or so of trading. You can see also there's been areas where it's acted as support, and when it comes back, it can act as potential resistance. So if we do come off more, if we start moving back up here, perhaps if we start consolidating, it could look for a positive break as long as the 5-day moving average starts curling back around there too. So that's what I'd be watching for in the price of Tesla. Now, let's get into the ISM Services PMI and JOLTS, because that's really kind of what that was the catalyst to really fire the trigger on volatility. And what do I mean by that? ISM Services business activity saw quite the uptick here month over month, and then prices paid saw a large increase, which is signaling some sticky inflation. JOLTS job openings jumped to 8.1 million. This is hinting at cooling wage pressures. Now, what was the impact? The impact was the 10-year yield fired off once again like a rocket ship. This negative divergence is still holding as we're creeping up to and around 4.7%. This sent TLT and bonds down to a low that we haven't seen for quite some time. I'm using the TLT unadjusted to give us more of a clear picture of price. That does not include the dividends. Now, as price is coming in, there is a little slot here, and sometimes when these gaps get filled, they can act as potential support. That is a possibility. And we do have the RSI moving into oversold conditions. Remember, oversold can remain oversold, but in and around 85 to around 83, this area where we saw prior support can be a potential area if you've been looking to accumulate bonds. Maybe that is a possibility to start up a position if it can get down into those ranges. Now, also the dollar came off of its lows significantly with these reports too, closing near and around the high. The dollar is currently down on the trading year, and typically what we've seen in the past when Trump came into office in 2017, the dollar did see weakness, and right now we are just really consolidating at these high levels. I want you to be mindful that we do have the price momentum oscillator with a lower high right here as price action is putting in higher highs. So we do have a subtle divergence here that if I want to see this market pull back, I would like to see this bearish crossover take place fully and start trending downwards. What else happened? Well, we can look at the Fed watch tool. And this is giving us probabilities of the next meeting, letting us know whether they are planning on cutting rates. Is that what's the market pricing in? Or if they're going to keep rates the same, which is what the market is pricing in. So you can see here, this was 1 month ago, 1 week ago, 1 day ago, and today. And notice how this line is going up. What does this mean? Well, this is for a 425 to 450 basis points for the target Fed funds rate. And that's where we currently are. So what this means is it's telling us that there's a higher probability as time has been moving forward that we're going to keep rates where they are for the January 29th meeting. On the flip side of that, you can look over here, 25 basis points lower, 400 to 425. This has been dropping, telling us that the probabilities for a rate cut in January have been diminishing. If you look out from January, March, May, June, and so forth, you can see that the probabilities to keep us actually at 425 to 450, you can see there's a 95% probability we'll be there in January, so no cut this month, right? And this makes sense given the context of what we're seeing in some of these reports, and we'll see what CPI brings up. I believe it's next week. I'm not 100% positive, but I think we're going to begin that CPI report here soon. Then we have March, 60% probability, and then we have about a coin toss going into May. So it looks like as it stands right now, the market's saying we're going to keep rates where they are. So what can force the hand of the Fed to actually lower rates? Well, if something breaks, they'll probably step in and do something about it. We've seen that multiple times where they step in and slam rates to the floor. So that I don't want to see that happen because that typically means that something bad typically happens. But what I'm looking at here on this larger time chart that I share frequently is the 10-year 3-month yield curve. And when it starts steepening from this uninversion, it does signal potential recession in the near future. And that's kind of what we're pointing at. Now, does that mean right now? No, it doesn't necessarily mean right now. It could mean at the end of this year. It could mean next year. Timing that is a very difficult thing, as we all are aware of. Now, the federal funds rate, you can see during the same time, they start cutting rates, they start cutting rates, start cutting rates, start cutting rates. And we're seeing a very similar situation that we saw going into the pandemic right before it happened, that we saw going into the financial crisis, and that we saw going into the popping of the dot-com bubble. The difference here is we have had the yield curve inverted for one of the longest times and deepest times throughout history. So this is obviously new territory that we are stepping into. So what happened today out of the 11 sectors? You can see energy led the way, and I'm gonna hit on that because that's not a good sign. Tech, consumer discretionary led the way to the downside. The markets were down. The volatility index was up. S&P 500 took it a bit on the chin there, down over 1%. The Dow Jones was down 42 basis points. It was down yesterday like 6 basis points. So that's actually held up pretty decent in terms of what else was going on in these markets. Even small caps surprisingly held their own within this volatility. Now, let's look at year to date. Year to date, the 11 sectors. Look at what's leading the way. Energy. Now, I mean, it's January 7th, people, so it's still early in the year. But when energy is the leading sector, this is not typically a good thing because if energy outperforms the S&P 500, what has happened in the past? Take a look. This chart here is energy relative to the S&P 500. So when green line go up, energy is stronger than the S&P 500. When line go up, energy stronger, S&P 500. Down here is the S&P 500, right? I don't got anything creative to say to that. However, what do you notice? Green go up, S&P 500 go down, okay? And what do we see here recently in 2025? We're seeing little line go up and S&P 500 is stalling out. We've seen this throughout history. This is not typically a good sign. And you could even look at like a sector rotation graph that shows the 11 sectors, and typically towards market tops or little, even shorter term cycle tops, energy becomes one of the higher performing names, as you can see it right there. So it's early in the year, so I wouldn't be jumping to conclusions right now. I'd be thinking like, hey, if this is just a small period in time, where can we see markets really start to rotate back into, and how can we potentially look, what will we look for? And I always like to go back to this chart and to see something like 10-year yield start to come back off, which could be beneficial for the markets. I think we got to pay close attention to oil because oil has been breaking out higher. Now, remember, Trump is coming into office. His thing is lower energy costs. So will he pull it off? Because the inflation trade right now seems like it's picking up pace. But right, energy is up. Right? Oil was up there. The black line is what I'm looking at here. The black line, and it did get faded. Is this just another potential fade about to happen? And if so, that's very important because you can see over here when oil faded, the 10-year yield followed. All right. When oil started rising over here, the 10-year yield followed. So if this starts coming off, it could actually present an opportunity back in to and around these bonds. Like TLT, for example, is just one of the proxies that I'm showing. If we look at oil right now, you can see right here that we kind of are breaking out into and around this trend line right here as we're kind of creeping up to it. We still have a declining larger time frame, the 200-day. The price momentum oscillator is actually above zero and it's trending higher over here. It's a little frothy here, so maybe it cools off. We'll see if it forms a bull flag, tries to go higher. But as it stands right now, below a declining 200-day, we're well above the 50 and it's starting to curl up as price is holding up. So is this trade actually going to see some success, or is it going to get faded like we've seen in the past? Well, time will obviously tell, and that's going to be an important asset to watch. Now, I want to get into kind of the volatility shock that we saw today and why I pay so close attention to the gamma flip line. Right here is a 5-minute chart of the S&P 500. Now, we had the macro data come out, right? The macro data was what? ISM services and JOLTS. Got to pay attention here, people. Okay, that came out at my time, 7 a.m. Pacific Standard Time, 10 a.m. Eastern Standard Time. 7 plus 3, right? There we go. Right here is 7 a.m. The gamma flip line was right here. So we were holding above the gamma flip line right here. Now, why is this important? Because when we're in negative gamma territory, when we're below the flip line, dealers change how they act. They sell into selling, they buy into buying, and it typically creates increased amount of volatility, okay? On the flip side of that, when it's above it, they buy the dip, they sell the rip, volatility comes in. But 7 a.m., pay close attention to this number, 7 a.m., what do we see here at 7 a.m.? This is the VIX, and at 7 a.m., crossed through the gamma flip line and fired off like a rocket ship. Now, I've shown this many different times. In fact, I can look at a net gamma chart and through the history of it, and this darker gray area shows when we're in negative gamma territory, and the white bars show when we're in positive gamma territory. And if I lay this over on a VIX chart, what you're seeing here is these gray shaded boxes showing you the times that we fall within the gamma flip line, and then when we go back into positive gamma, right, that's where the box ends. And what you'll see here is we get into negative gamma territory, the VIX rises, we get out of it, it comes off. It rises, it comes off. It rose, it come off. It rose, it came off. It rose, it came off, right? It rose, it came off. Right here, got in quickly, even though it was rising. And then recently, we've been kind of in more of a neutral stance because we've been kind of going in and out and going in and out over here. And right now, we just entered back into negative gamma territory. So I think you got to pay close attention as we're under this flip line because that is obviously not a great sign for specific types of trading, right? If you're in negative gamma, a lot of day traders love this type of volatility and two-way price action that comes. Now, this is where it gets interesting. This is the expected moves for the week. I draw this out. I have a lot of history on this stuff. And you can see right here, this week, the market said on Friday, hey, we're handicapping risk looking forward. This brought a plus or minus $8.45 move. Starting the week, we came up to and around that level, missed it by a few cents over here, a buck or so. And then we came back off closing, so we closed slightly in negative territory for the week. Okay, now this is where I find so interesting. We're within this. We haven't tagged it yet. There's always a high probability of tagging these expected moves. The higher probability would technically be to the lower one as it stands right now, just given the context that we're negative on the week. But that's not what I want to talk about. Or that's more of a gamble than anything. But what I find so interesting here is we've had now Monday and Tuesday. We have left in the trading week Wednesday and Friday. So we have 2 days left. Now, in these 2 days, we went basically from this high to this low, which is about $13 and some change. The market, till the end of the week, the expected move in the implied vol is giving us handicapping still $7.10 of risk. This is with only 2 trading days left. And we started the week with $8.45. So people, you got to buckle up. There's a lot of risk still being priced in this market, and we need to be aware of that. That means we can be snapshotted right back up here very quickly. Or if the market doesn't like what it sees, especially with what's up ahead, FOMC minutes, ADP, we got some Fed speak, we got more macro data on the horizon, including big ones, right? Non-farm payrolls, unemployment report, right? This is going to be important. It's going to create, once again, more volatility in these markets. And that's what the market is basically saying right now. All right, let's get a little bit more tactical and look at the smaller time frame charts. We'll look at where we stand within these weekly expected moves, some of the year-to-date key levels to keep an eye on, and the daily expected moves. So this is the SPY on the 15-minute time frame. We're below the 5-day moving average, right? So yesterday we talked about, hey, if it gets to the daily expected move, what you want to watch for, which it did, by the way, it closed outside of it, or it was basically, I think it was right around here, it was kind of like right in this area was the zone, but I don't have that chart with me right now. Okay, what we said was if it comes down into these areas, start to look for strength. So we started seeing some strength here, but we didn't see the higher low, right? It faded and created a lower low. We went up again. It faded and created another lower low. During that process, we also were putting in lower highs. So this needs to change in the near term to feel more confident that the market's going to go higher. Now, there's some key levels here that I want to pay close attention to. First and foremost, the white level right here is from the macro data drop. And you can see when that came out, we closed under it and we started to struggle to get back above it. So first and foremost, getting back above that level is going to be incredibly important. So right here to right here is obviously a lot of resistance that the market needs to recoup. That includes the year-to-date anchored volume weighted average price. What is this telling us right now when price is below it? It tells us that the average person or average buyer, right, based off of this time and volume is now underwater, right? So the average volume that traded for the year-to-date perspective, we're below that line, okay, which could be a discount. We don't know where the market's going to go exactly, but it would be a lot better if we can reclaim that and we can hold above those levels. We're also below the week-to-date. Okay, so another level that I wanted to call out here was last year's closing price. We are above this, which means what? It means that we are still positive on the year. We saw a nice move, and now we're seeing a consolidation. An interesting trend line to keep an eye on is these levels right here, as we've been kind of hitting these lows 3 times. That can make a trend line. So if we come up, just watch to see how the market reacts and responds, and if we can get back above some of these key levels in the near term. If the market wants to continue to sell off, pay attention to these lower implied moves, right? The lower area right here there's a lot of confluence. You have the daily implied zone, which is the daily expected move, and the VIX daily expected move, and right at the weekly implied move too. And these levels are also kind of in confluence from this prior area of support resistance turn support right here. So right in and around these areas, there's a lot of confluence. If price to come down there, what do you look for? Well, I'd still be looking for higher lows, breaking to a higher high and seeing some strength. I don't know if it's going to get down there. So what am I looking for? Well, there's a lot of congestion up ahead. So I'm looking to see if it can reclaim the 5-day moving average and it can reclaim the year-to-date anchored volume weighted average price. That would make me feel a lot more confident in this current market. So this is kind of a standstill here for me as conditions are changing in the market. I gotta be mindful of it and take my foot off the pedal a bit. If you take a look at the Qs, you can go ahead and screenshot this. I'm not gonna dive too much into this, but these are the weekly expected moves for the Qs, the daily implied moves, and all these levels here too. So go ahead and pause it, take a screenshot, put them on your chart, see how it works. Here's the IWM. Same situation, you got your key levels. As the market's been kind of pulling in over here, the IWM struggled to get back above the macro data VWAP. It came back into the close, so you'd want to see that kind of recoup. The 5-day moving average here is actually still inclining, so right now it should be yellow on the trend changer. I want to go into the market conditions now and show you how they've changed, right? This is the gamma flip line as it stands right now. It's about 59.60, plus or minus a little bit. And we came into 5,900. So yesterday we talked about 5,900 and we talked about 6,100 being some key levels. Market pulled into 5,900. You honestly, at this moment, you want to hold 5,900. You don't want to get below there. I'd say you'd be more bullish above it, but there's still some levels you want to overtake. Overall, what have we been doing? We've been trading sideways, but we're sitting here at the put wall right now. We'll see come tomorrow morning, and I'll post that in the Discord to see if traders are reaching out further to the downside, and we maybe see some other levels grow to be a new put wall, like for example, 5850 or 5800 to be a possibility here. So in negative gamma territory, and then what are the direction of the 5-day moving average telling us? It's telling us caution on SPY. Caution means what? It means price is below the average, but it's still trending the opposite direction. So we need to reclaim this year-to-date anchored volume weighted average price. We need to reclaim the 5-day moving average and have it start to turn back up again. The Qs are currently, they're flat, but it is starting to calculate to the downside, being red. So we want to see this recovered as well. IWM is currently yellow, both beneath the 5-day moving average and the anchored volume weighted average price. Semiconductors, right? We saw the pullback here because really NVIDIA and some other names here to draw it down, but we're actually still above that rising 5-day moving average in this current moment, below the year-to-date anchored volume weighted average price. And this, to me, I like to see this type of stuff. Yesterday, we talked about how it'd be nice to see semiconductors come off a bit. Now, I don't know what this is going to turn into, but what I will say is if this comes off and it eventually reclaims the year-to-date anchored volume weighted average price, I would be looking for something like this to potentially play into to go retest these highs. If it doesn't show me strength, right? If the market doesn't want to show me strength, why am I going to be the one to try to fix that? I don't have the power behind me to fix the semiconductors ETF. So I'd prefer the market to prove itself and me to join along. I'm not trying to catch a bottom here. XBI is actually surprisingly holding up rather well right here. It's the 5-day moving average is inclining. We're holding the year-to-date anchored volume weighted average price. And then DIA turned red today. It's once again kind of flat, uncertain. A lot of these are kind of flat and uncertain in this current context. That's all I got for you on today's episode, everybody. Hope it gave you some good insights. I'll see you back on the next.